Most people sleep soundly at night, believing the numbers in their bank account represent cash sitting safely in a steel vault. But here is the uncomfortable truth. That money does not exist, not in the way you think. If every depositor walked into their bank tomorrow morning and asked for their cash, the entire global financial system would collapse by lunch. This is not a glitch in the system, it is the system. This mechanism is older than central banks, older than paper currency, and older than the modern economy itself. It began as a deceptive gamble by medieval merchants, and over 4 centuries, it grew into the engine that powers global debt, inflation, and the illusion of wealth. To understand how we got here, we have to look back to a time when money had physical weight. In medieval Europe, wealth was gold and silver. But carrying heavy sacks of bullion was dangerous. You were a walking target. So, merchants began storing their gold with goldsmiths, men with fortified vaults and private security. In return, the goldsmith issued a paper receipt, a simple promise. Whoever holds this paper can claim the gold. Soon, the market realized these receipts were far more convenient than the metal itself. Why haul gold across the city when you can just hand over a slip of paper? And that is when the goldsmiths noticed a pattern that would change the world. Almost nobody ever came to get their gold. As long as the people trusted the goldsmith, the gold sat untouched. So the goldsmiths took a gamble. If they had 1,000 gold coins in the vault, they issued 2,000 receipts. They lent these extra receipts out to borrowers, charging interest on gold that did not exist. They created money out of thin air. As long as every depositor didn't panic at the same time, the trick worked. It was fraud, technically, but it was also revolutionary. It separated the concept of money from physical reality. This was the birth of the banking system. Governments quickly realized the power of this illusion. In 1694, the Bank of England was formed, not to serve the people, but to bail out a crown drowning in war debt. The bank lent the king money it didn't physically possess, and the taxpayers paid the interest. The United States eventually followed suit. And while bank runs occasionally exposed the lie, the system wasn't abolished. It was fortified. Central banks were created essentially to act as the ultimate backstop, ensuring the illusion could never fully break. Now let's fast forward to the digital age. You deposit $100. You see that balance on your screen. But the bank used to keep only a fraction of that, traditionally about 10%. The rest was lent out to someone else. Your $100 became $90 in someone else's hands, then $81, then $72. Through this multiplier effect, your single deposit could birth nearly $1,000 of circulating debt. But here is the part that should keep you up at night. Since 2020, the reserve requirement in the United States has been set to zero. Banks are no longer constrained by the deposits they hold. They do not lend your money. They create new money the moment they sign a loan. Your bank balance isn't central bank money. It is commercial bank money, essentially digital IOUs. So what stops them from printing infinity? A set of global rules known as the Basel Accords. These aren't laws passed by your Congress or Parliament. They are rules set by unelected technocrats in Switzerland. Under Basel rules, banks are limited not by deposits, but by capital buffers, their ability to absorb losses. This shift means that over 90% of the money in existence today was not printed by a government. It was typed into existence by a commercial bank. The consequences of this system are unavoidable. First, inflation, because the money supply expands faster than the production of real goods. Second, perpetual debt. Since every dollar enters the economy as a loan, there is always more debt due than there is money to pay it. It is a game of musical chairs where someone must always lose. And finally, the concentration of power. Those who own assets, real estate, stocks, gold, ride the wave of inflation. Those who work for wages or save in cash get crushed. History offers us warnings. The panics of the 19th century, the Great Depression, the 2008 crash. Every crisis tells the same story. When confidence cracks, the illusion evaporates. But governments will always choose to print more, to patch the cracks, because without this illusion, the modern world stops turning. Some countries still maintain reserve requirements, like Brazil, India, and China. But the global blueprint remains the same. Money is no longer a store of value. It is a mechanism of control and liquidity. So, what does this mean for you? It means you must understand the difference between currency and wealth. Currency is the digital illusion that loses value by design. Wealth is land, resources, business ownership, and skills, things that cannot be printed away. If your money is born as someone else's debt, your financial freedom depends on stepping outside of that cycle. The trick that began with medieval goldsmiths now runs the planet. But once you see the strings, you can no longer be a puppet. If this changed how you see your bank account, subscribe. We decode the history they don't teach you in school.